If you've ever wanted to start investing but had no idea where to begin, stocks, funds, ETFs, this video is for you because the investing world loves to make things sound complicated, but at its core, investing is actually simple. And once you understand these three things, you'll have a clearer picture of your financial future than most people ever will. Welcome back to Knox Invests. We've talked about mindset, budgeting, and debt. Today, we're getting into the part most people are actually waiting for: investing. Specifically, what are stocks? What are index funds? And what are ETFs? How are they different? And which one makes the most sense if you're just starting out? Let's break it down. A stock is a tiny piece of ownership in a company. When you buy one share of Apple, you own a very small fraction of Apple. If Apple grows and becomes more valuable, your share grows too. If Apple struggles, your share loses value. Stocks can make you a lot of money. They can also lose you a lot of money. And that's the core risk. You're betting on one company at a time. Picking individual stocks is extremely difficult, even for professional fund managers. Studies consistently show that over long periods, most professional stock pickers fail to beat the overall market. So what does the smart money do instead? Instead of betting on one company, an index fund lets you bet on the entire market at once. An index fund tracks a market index, like the S&P 500, which is a collection of the 500 largest companies in the United States. When you invest in an S&P 500 index fund, you own a tiny piece of all 500 companies at once: Apple, Microsoft, Amazon, Google, all of them in one investment. If one company fails, it barely affects you, because 499 others are still in there. This is called diversification, and it's one of the most powerful risk management tools in investing. Index funds also come with very low fees because there's no fund manager trying to pick winners. The fund just follows the index automatically. Warren Buffett himself, one of the greatest investors in history, has publicly said that for most everyday people, a low-cost S&P 500 index fund is the best investment they can make. An ETF, or exchange-traded fund, is very similar to an index fund, with one key difference: it trades on the stock market like a regular stock. With a traditional index fund, you buy at the end of the day at whatever the closing price is. With an ETF, you can buy and sell anytime the market is open, just like a stock. For most beginners, this distinction doesn't matter much. Both index funds and ETFs are excellent ways to invest in a diversified basket of companies at low cost. The most popular ETFs in the world track the same indexes: the S&P 500, the total U.S. market, the global market. Names like VOO, VTI, and SPY are some of the most widely held investments on the planet. Here's my honest take. If you're just starting out, don't try to pick individual stocks. The odds are not in your favor, and the time and research required is enormous. Start with a simple low-cost index fund or ETF that tracks the S&P 500 or the total market. Invest a fixed amount every month. Remember dollar cost averaging from our compound interest video, and leave it alone for years. This is not exciting. It's not going to make you rich overnight. But it's the strategy that has consistently built real wealth for ordinary people over long periods of time. Simple beats clever. Every time. Here's your action step this week. Look up what a S&P 500 ETF is. Just research it. You don't have to buy anything yet. Just understand what it is and how it works. Drop a comment below. What's the one thing about investing that's always confused you? I'll answer as many as I can. Next video, we're talking about the emergency fund, what it is, how much you actually need, and why it's the foundation of everything else. Subscribe so you don't miss it. Thanks for watching. See you in the next video.